Alright, in the previous chapter we talked about the basics of financial statements and about cash flows, and in this chapter what we're going to do is dig a little bit more into that. Here we're going to assume that you already understand what's on the financial statements, and we're going to calculate some ratios all available from the data that is on the financial statements, and each ratio is going to tell us something about the company. So just as a review, here's kind of what the balance sheet looks like. We're still following the hypothetical case of that company DeLeon that was in the chapter that we just previously covered, chapter 3. And in fact, we actually have one additional year of data in this chapter that we're going to be looking at than we had before. So in the previous chapter we had 2 years worth of data. In this chapter we have the most recent year, the one before, and actually there's one before that. You can see this information a little bit better as you go throughout the lecture on this chapter if you will turn in your textbook to the back of chapter 4. Okay? If you'll turn to the back of chapter 4, if you're looking at the 7th edition of the textbook, then the case begins, I think, on page 132, and here you're looking at the balance sheets for this company on page 133. And actually, if you go down to the next page, 134, you'll also see the income statements for 3 years for DeLeon. So it will be useful for you to have that information just readily accessible as we go throughout this chapter. So I would suggest that if you don't have your book, go ahead and pause the video and get that, and make sure that you just have that close at hand as we go throughout all of this information. Okay. Again, we do have, of course, the balance sheet. Here's the asset side. Here's the liabilities and equity side. This is nothing different from what you've already seen in chapter 3, except that there is one additional year worth of data here that we'll also incorporate, but it doesn't really change that much. I mean, we would still have the same sorts of observations. And of course, here's the income statement, and we've seen that before. There's really nothing new here, and again, we have other data associated with that income statement that sheds further light onto what's going on. Okay, like I said, we are going to get into ratio analysis on these financial statements. By the end of this lesson, you're probably going to feel a little bit inundated with ratio information. You know, by the end of this, you're probably going to say, oh, what, another ratio? You know, what is this one about? So it's useful to say up front, I mean, why are we doing this stuff? Are we calculating these ratios just for the heck of it, or do they help us with something? Why are they useful? Well, it turns out that they are useful, and no, we don't just do this to torture you and give you more work to do. Ratios help us to standardize numbers on financial statements and to facilitate comparisons between two companies. An example that I often give is this. Let's suppose that I told you that a company made $1 million in profits last year. Would you be impressed with that? Well, think about it for a minute. You might or you might not be. What if I told you further that the company with $1 million of profits was Walmart? Well, if that was the case, you would probably say, what, $1 million? That's all? They're really slacking. I mean, their business is going downhill if that's all they're earning. And you'd be right. A company of their size really should be earning far, far more than that. On the other hand, if I told you that the $1 million profit company was a business that was started up by a teenager who decided to mow some lawns in the summer, and it sort of grew from there, and in a couple of years' time they were making $1 million of profits, you would be very impressed indeed, as well you should be, okay, because that person made a tremendous amount of profit on probably very limited resources. So that might be an extreme example, but it does make the point that sometimes we need to look at more than just one number on the financial statements to get a picture of what is really going on and whether a company is doing well or not. All right, so those ratios can help us to standardize numbers, and that way we can better compare whether one company is doing a good job or should I say a better job than another in a certain area. And that leads into the next point, that these ratios can help to highlight strengths and weaknesses for firms. So they can point out areas that a company is doing just fine in, and other areas where the company honestly needs some improvement. As we do these ratio analyses throughout the entire chapter, we are going to be thinking of it two ways. In one way, we're going to be doing a trend analysis, and there's nothing complicated about this. A trend analysis just means that we're going to be looking at this ratio for this company over time. How has it been changing over the last few years? Is it heading in the right direction? Is it heading in the wrong direction? Is it staying about the same? And then secondly, we are going to be doing a peer or industry analysis, and there's nothing complicated about that either. But the idea is that we're going to be looking at where the company is versus where the rest of its competitors currently are. Is it doing better than its competitors, or is it doing worse in certain areas? And that's the second type of question that we will answer as we look at all of these different ratios. Okay, going through this lesson, we will be looking at 5 major categories of ratios. The first one will be liquidity ratios. These ratios will give us some idea of whether the company can pay its bills in the short term. So can it at least stay afloat over the next year? Can it make its required payments? Then we have asset management ratios, and these cover a variety of things. So we'll be looking at sales versus assets like inventory. Okay, we'll be looking at sales versus fixed assets. We'll even be looking at total assets. We'll have several things to examine there. Then we have debt management ratios. These answer 2 questions. Okay, one question is, what is our mix of debt financing versus equity financing? Remember, looking back at the balance sheet, as we saw here, there is a mixture, and every firm has a mixture. Some of its financing comes from debt, and some of its financing comes from equity. So if you'll look over here, you'll see that roughly this top part, all right, everything in this area shows the amount of debt financing that the firm has, and everything here shows the equity financing. Every firm has its own capital structure. In other words, it's a debt versus equity mixture. The debt ratio is one thing that tells us about that debt versus equity mixture. Okay, so that's one question. And then the other question is just regarding the debt that we do have, are we able to service it? Are we making enough money that we can actually pay at least the finance charges and hopefully more than that? Then we have profitability ratios. Here we're looking at the company's profits versus its sales revenue, for example. So we may be asking the question, how much of each dollar in sales does the company actually get to keep as profits? And we may also be looking at its profitability compared to things like total assets. Kind of like I did in that example earlier. I was talking about, would you be impressed with a company that had a net income or a net profit of $1 million? And the answer was, we didn't exactly say it, but the answer was it kind of depends on how big of a company it is. If it's a company like Walmart with a huge amount of assets, then you wouldn't be very impressed with just $1 million in profits. But if it was a very small startup company and it had considerably less in assets, you might be very impressed indeed. So we'll be calculating this type of ratio as we get into that section of our lecture. And then we have market value ratios, and these compare the market price of the stock versus information that is on the financial statements. So this is the only kind of ratio that actually looks at what investors think and what they're willing to pay compared to the information that's on the balance sheet and the income statement. But we'll have more on that later. Let's begin with the first category of ratio, liquidity. Okay, so let's look here at DeLeon's forecasted current ratio and quick ratio for the most recent year that is on the financial statements. The current ratio is what we'll look at first, and sometimes the current ratio is referred to as the working capital ratio. Why? Because working capital refers to our short-term assets, and that is what we're looking at here. The current ratio is very simple to calculate. You just take your current assets and divide by current liabilities. And this information is easy to get from the company's balance sheet. If we go over to the asset part of the balance sheet for the most recent year, we will see that here is total current assets. All right, this is 2.68 million, and the numbers over on this page are in thousands, so that's why you see it written as just 2680. Okay, then if we look at the current liabilities, that would be 1,144,800, or over here on this sheet it says 1145. Again, these numbers are in thousands for whatever reason. Okay, so you take 2680 divided by 1145 and you get 2.34. The little X that you see here is nothing to worry about. Okay, it just means times. It's not like an unknown variable that you have to solve for. It just means 2.34 times. In other words, the level of current assets is 2.34 times what we have in current liabilities. Think about what that means for just a minute. It means that for every dollar that we have in short-term debt that has to be repaid sometime over the next year, we have $2.34 in current assets. In other words, short-term assets. So as long as everything goes according to plan, we really should be able to pay our bills over the next year. I mean, we do have enough cash, accounts receivable which should be collected and converted to cash, and of course inventory that hopefully will be sold and converted to cash within a year's time. So looking at all of that, we should be able to cover at least our short-term bills. Doesn't look like there's any immediate danger there. Now, going down here to the quick ratio, let me explain that for a minute. The quick ratio is also known as the acid test ratio. Mostly we'll use the term quick ratio, but you should be at least aware of the other term also. It is pretty much the same thing as the current ratio with one exception. Up here in the numerator of this expression, instead of taking all current assets, we are going to be looking at current assets minus inventories. So going back over here to our balance sheet, notice that we have three different current assets listed. Of course, we have cash, then we have accounts receivable, and we have inventories. Of these three, inventories are considered to be the least liquid. Cash obviously is very liquid, you can use it right away. Accounts receivable still should be pretty liquid. You should be collecting that money from customers pretty soon. They legally owe you that money within a short period of time. But inventories, you know, those represent sales that haven't yet even been made. So I guess this ratio is looking at the question, what if you run into trouble with these inventories? What if you do have trouble actually selling them and you go through a slump? You're either not able to sell any or you sell a whole lot less than you thought you would, and so you're not able to convert those to cash like you would normally expect. How able are you to pay your short-term bills on just the cash you have and the accounts receivable that you're of course legally entitled to collect? Let's assume that all inventories, you couldn't sell any of it. How able would you be to get by on just the cash and accounts receivable and using that as a basis of repaying your short-term debt? Well, going back over here, we still have the same amount in current liabilities that we're looking at, okay? That has to be paid for us to stay afloat. But we're taking this 2680 in current assets, again that is in thousands, and we're subtracting off the inventory against it. So we could take a look at our calculator. In fact, let me pull that up for just a minute. Okay, so we could take 2680 and subtract off 1716. Okay, and that gives us 964. 964 is the total of cash and accounts receivable, just those two. And again, that is in thousands. Then we'll divide by 1145. That is our total for current liabilities. So looking at that, we get a ratio of 0.84, just as it says here on the slide. And that, of course, tells us that for every dollar of current liabilities that DeLeon has, it has only 84 cents in total cash and accounts receivable. So if DeLeon was not able to sell any of its inventories over the next year, I know that's probably an extreme circumstance, but if it ran into problems that big, then it actually could run into trouble paying its short-term bills, and of course that wouldn't be good. So this tells you that DeLeon definitely needs to be able to sell at least some of its inventories in order to remain in business. Of course, realistically it should be able to do at least some. Okay, so are these ratios good or bad? Remember we said we were going to be looking at trend analysis and a peer or industry analysis. We talked about that over here. Well, now is the time for us to do that. If you were to calculate these ratios over all 3 years of the financial statements, remember here in your text you actually have not just 1 year but 3 years worth of data, 3 years worth of balance sheets and income statements for the firm. If you were to do that for all 3 of these years, this is what you'd see. First, let's look at the trend that's going on here. For the current ratio, a couple years ago the value was 2.3, then it dropped in the second year to 1.2. Now it's supposed to come back to basically where it was before, so 2.34. And for the quick ratio, it was at 0.85, then it dropped a lot the next year, then it came back up to about the same level where it was before. So it looks like the company is rebounding from its bad year. However, it's still a little below average for the industry. Notice that the industry average for the current ratio is 2.7. So this means that companies that are in DeLeon's same general line of work, same general area of business, they have an average current ratio of 2.7. DeLeon's only in the 2.3 range. And for the quick ratio, the average is 1 for the industry. DeLeon is still less than that. So this tells me that DeLeon's liquidity position is a little bit weak. It might need some additional current assets or perhaps fewer current liabilities in order to feel just a little bit safer. No major alarm bells going off here. This isn't a red flag, it's more like a kind of a yellow flag, but this is something that DeLeon might want to consider shoring up to give itself the best possible chance of paying its bills in the short run. So DeLeon, compared to its competitors, is a little bit more likely to have problems paying its bills in the short run. It's not certain, doesn't mean that it's going to fail. It just means that they have fewer short-term assets to draw on.